Hey everybody, this is Halstead and Andrew McMillan with REH CPAs. Andrew, we do a lot of tax and accounting for home builders. And one of the questions that comes up, especially around year end and tax time, is, the different accounting methods that home builders, it's kind of specific to home builders, people in the construction industry, what kind of a tax and accounting method that they have to use whenever it comes to reporting their taxes. I was wondering if today you could kind of go over that briefly and give us the rundown on that.
Yeah, so home builders, they operate under what are considered long-term contracts. So you get a project to build a home for someone, and that's considered typically a long-term contract in the eyes of the IRS. So what is a long-term contract? It's any job that won't be completed by the end of that year. So for example, you start a project on a house that you're going to build for someone on December 1st, and that project won't be completed until the next year. It's considered a long-term contract. So the IRS has typically two ways to treat these long-term contracts. You pay taxes on this income under the percentage of completion method or the completed contract method. So the percentage of completed method, it's a bit complicated. It's more sophisticated, but basically you recognize profit. You pay taxes on profit on that job as you complete the work. So at the end of the year, if you're 25% complete with a job, then you have to recognize 25% of that profit.
Right.
So there's it can get a little complicated, but that's the percentage of completed.
That's the gist
method.
of it.
That's
anyways.
the gist of it. So the other method that we see a lot that we like to use is the completed contract method. And what the completed contract method is you recognize profit on a job when it's complete, when you're done with that job typically. So you don't have to recognize profit based on a percentage of completion, anything like that. It's just when the job's done and you're completed with that job, typically you close it and you recognize that profit and you pay taxes on that profit when it's done with.
Right.
To be eligible for this method, there are some limitations though. And one of them, you have to meet two rules. One of them being that you are considered a small contractor, which means that your average annual gross receipts are less than $25 million for the last 3 years, which a lot of guys fall underneath that. The other one is that your contract has to be completed within 2 years. It can't be a long-term contract that's going to be 5 years or something. It has to be completed within 2 years. So most home builds fall within those rules and they use the completed contract method. They use that to pay their taxes, and it's an easier way to do it.
Right.
You don't have to, there's not as much calculating in it, but it's very important to keep your books in good order, because when we do tax returns for home builders, we're looking at that year end. We're trying to figure out what's not closed and what we can pull off of there to not pay taxes on yet.
Because the completed contract method, especially for home builders, is kind of nice because depending on how their cash flow comes in, they can actually get, if they're not doing it correctly, they can actually get hit with a really big tax bill. Let's say one year they got all their draws in, let's say they got $500,000 in draws to build a house for somebody, and they didn't do the completed contract method. We've seen it before where they've recognized that $500,000 as income with no expenses against it. Under the completed contract method, if you pull that $500,000 and you're at year end, you put that on the balance sheet as a liability. And then as you build the house, once the house is completed, all of that goes over from the balance sheet to the profit and loss as taxable income.
Right.
And it's not until that house is completed that you'll recognize the income. So even if you were at year end, let's say you're up to 90% complete on the house, it's still not done. So you don't have to recognize the profit on that. That all stays on the balance sheet until that house is completed. So it's very important to make sure and get that right.
Yeah, it's a big thing that we do during tax planning for all of our construction residential home builders, just making sure that we got a clear picture of what jobs are going to be recognized that year to pay taxes.
Yeah, because we've had home builders come to us before and say, man, I paid a ton of taxes the past couple of years. And it doesn't make sense because I'm losing money. And we look and we're like, yeah, man, you recognized all those draws as income in the year in which you drew them down, but you didn't have the expenses to offset them. Right. And then your next year you had a big loss. Yeah. So yeah, you're not doing this correctly, and we have to go back and amend, and we get them, so yeah, make sure you understand that and you're getting that right.
Yeah. So it's definitely an important piece for our home builders. So.
Awesome. Well, it's really good information, Andrew. I appreciate it. And like I said, if you're a home builder, like I said, we do a lot of this. So if you want to understand this better, feel free to give us a call and we'll sit down and go over it with you.